Moving targets of borrowing money. That's what we're going to talk about today. The ever-changing interest rates. How do I get money? Where are they going? Those moving targets. Join us as we dive in with Tracy Morgan-Frick. This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home. That's why I go beyond the transaction to offer my opinions for adulting made simple. All right, so today I have one of my great friends, my trusted lender partner, Tracy Morgan-Frick, here with me to talk all about mortgage rates. Welcome, Tracy, to the show.
Thank you, Jessica. I'm excited to be here with you.
Tracy, you have been my go-to for my clients, pretty rock solid for the last 5 years for my own personal financing stuff. You are just my absolute go-to lender that I trust. And so I'm so glad to have you here today to share your expertise with our listeners. And let's talk about the weird mortgage rates. What a crazy thing.
It is a crazy thing, Jessica. And I tell you, so many customers right now are so concerned about where the interest rates are going. And they're not buying houses currently, or they've really slowed down because they think the rates will get a lot better. And nobody knows what rates are going to do. With the new administration, the feds announced they were dropping rates a half. Everybody and their brother called me, hey, is my interest rate dropping a half a point? No. The Fed funds rate is the rate that let the banks loan each other on short-term loans. It does affect the 10-year yield, which does affect mortgage rates, but it took a while to kind of trickle down to us, and then it tumbled a little bit.
That's something that a lot of people don't understand. They go, oh, the Fed cut rates. That means interest rates are dropping. Not really. The Fed rates are really what banks pay to loan money.
To each other.
Right.
Not to us.
Right. It's not what we pay. That's what the banks pay.
Right. But it does have, a little bit of activity with the 10-year yield, and that's what mortgage lenders are looking at, is where that's going. But then, it used to be you could look at that and you knew right where rates were going to be. Today, rates change 2 and 3 times a day. It's for me, I always laugh and say it's like the slot machines because I'll be quoting a rate and then all of a sudden I get an email that says rates are worse. And then we have to wait about 15 minutes and then the rates change and then they come back down. They're not huge adjustments.
Just minor changes.
Yeah, for us to watch. And a lot of people, 7% just completely freaked them out. From 1971 until 2024, rates were at a high in 1981 of 18.63. So if you think 7% is high, can you imagine 1981?
All right, so if we're looking at over the last 100 years, what is the most common interest rate as we average out? I know that's a long time, right?
Right.
But that gives us a good look back at history. So what is the average of the last 100 years?
Probably 7.75 is where economists are showing us where it's been over the last 100.
So, Tracy, there's so much of stuff that affects interest rates.
Right.
Inflation has been a big factor over the last couple of years, but we'll talk about that a little more. But what it costs banks to loan and the Federal Reserve and the strength of the dollar. And it's hard for the average person to understand. That's why I felt it was important to go through really the history. So let's talk about the 80s. Where were we in the 80s?
1981 was our high at 18.63.
18.63. Did people still buy houses then?
They did.
Isn't that crazy?
It is crazy.
And then we travel a little forward into the 90s. How were rates then?
We started to seeing them come in the 9s and 10s, drop to the 8s, back to the 9s. It moved around a little bit during then.
Average still pretty high compared to what people would say today. I remember I bought my first house when I was 19 in 1999, and rates were 9%.
Right.
I still bought a house. Bought my first one at rates were 9%.
Yeah.
I was able to do a 5-year ARM to get it down to 7, so there was some ways to work it out. But rates were 9%, and people were still buying.
That's right.
18%, they were still buying. Why is that?
Because they never saw 2 and 3%. And that's got people so freaked out that they think it'll go back to that. It's never going to go back to 2 and 3%. We saw what happened. We saw how labor rates went up, cost of materials went up. Now the housing is continuing to go up.
The thing is no matter what the rate is, if you are renting, you're wasting your money.
Exactly.
If you're making a mortgage payment, you're building wealth.
That's
no
right.
matter what that interest rate is, pretty much. So you're going to think I'm crazy, but I think the best interest rate is somewhere between 6 and 8%.
I agree.
And it's crazy that people are like, what? Are you kidding me? I don't want to pay that. Here's why I think it is perfect from an economical standpoint, right? So if you remember back like when rates were 9% in the 90s, we made money on our checking account. We got interest on our checking account,
What
not
about
just
your
savings.
401k?
Yeah, it was awesome. I mean, I remember I was getting 1% on my checking account, not 0.01. 1% interest I was earning on my checking account. So if you have money sitting in the bank, if you have $100 that you put in the bank on January, and we're going to keep it there, let's say, until December 31st.
Right.
And if inflation was at a low rate of 3%, and that money did not earn at least 3%, its buying power is down, and that $100 is now worth 97.
Right.
So you've put money in the bank that's lost money. No one wants that, right? So when rates are 6 to 8%, it's affordable to borrow. But it also makes sense to earn money. You can actually earn money on your money. And I think that's why it's the most common rate over 100 years is because that's what balances our economy.
That's right. It works for everything.
So let's talk about when rates are too low. I think when we drop down to the 2s and the 3s in the mid 2000s, I noticed you couldn't earn money anywhere.
No.
That's not good because then we're not incentivizing people to save at all. We're just building a society of debt because why would we save money?
And what we saw with real estate is that it just was crazy. Everybody was buying. Housing prices went up rapidly because it was a lot lower monthly payment at those 2.5%, 3% interest rates.
Well, and also because the stock market. One thing a lot of people don't realize is other than the one recession that happened, all the recessions over the past 100 years, they all grew real estate, except for the one that happened because of real estate.
Exactly.
So, yes, 2007, 2008, that crash really happened because of bad mortgages and because of real estate. So that one is the only recession that real estate did not grow during because normally when the stock market drops, what do? They pull it out of the stock market and they put it in real estate.
Right.
It's a tangible product. That's why we've always had real estate investors. I'm a big believer. We go to work to make a living. We buy real estate to build wealth. And they're two total different things.
Exactly.
So we touched a little bit on this, but I think rates are going to drop. Should I wait to buy a house?
I would not because I think the housing prices are going to continue to increase. And again, you take that increase and add it to your note, it's a lot, and it just doesn't go away. With interest rates, we can lower that monthly payment, and you're not adding that debt.
That's a great thing, right? So the bank is locked into the interest rate at a 30-year fixed loan. The bank's locked into that rate, but I'm not locked in.
That's right.
If I want to refinance, I can. With most good loans, there's no prepayment penalty or anything like that. So I can refinance at any time. So when is a good time to refinance?
Well, I always tell our customers, you're still going to have closing costs. There's going to be an appraisal, there's state fees, there's lender fees. So what you want to make sure of is that the fees that you're paying, you can recoup quickly on your monthly payment. So there's not a general rule. A lot of people go, well, normally if you can get your rate a point lower, it's worth it. Well, not on a $780,000 loan. It would be huge, of course, a point. But if it's a $180,000 loan, did that 1 point really help if you paid $8,000, $9,000 in closing cost? We have to kind of look at it and make sure you're going to recoup that money.
You know, clients ask me that question all the time. We send them the monthly report with where their interest rate is and where they currently are, and to help them decide, is it a great time to refinance or not? When they call me, I always say, I can tell you how you know. You call Tracy, and she'll tell you because she'll run those numbers and say, you know what, it's not going to save you enough right now. Wait till it gets to this. Or you'll say, you know what, this is going to save you enough that it's worth those closing costs. Even though a lot of times those closing costs are built back into the loan, it's increasing
that
balance.
Monthly payment and the loan balance. That's exactly right.
So you got to make sure it makes sense. But the easiest way to answer that question is call Tracy, right?
That's right. Call Tracy. And that's the same thing we talk about with points. So your government loans are FHA and VA. Those are our most popular loans. And then you have your conventional loans where those loans are sold on the secondary market with Fannie Mae, Freddie Mac, and the big investors. So the government loan rates are always lower, pretty much have been for years. So right now we're seeing the high 5s and low 6s, and sometimes, depending on the credit score, they might have to pay points. And points, we will show you the rate sheet, and if you pay a point, that's 1% of your loan amount. And that, say it's a $360,000 loan, you pay $3,600. 1 point doesn't buy down the rate a point. It gives you the next best rate at that fee. It costs $36, but you saved $45 a month. Can we recoup the $36 you paid in just 3 short years? If you can't save your money within 3 years, my thought is don't buy points, because you're going to do something with a mortgage every 5 to 7 years.
Right. Refinance, move,
Renovate, sell it. Yeah. So look at that. And I always try to advise my customers, you'd be better off to take that $3,600 down the road and make a principal reduction.
So let's talk about principal reductions, because as my primary lender, I love to tell clients about this. So whenever a client has a mortgage and I know that they're going to make a lump sum payment in the near future, maybe they're going to sell a house and roll that equity into their new house, I always tell them, tell Tracy, you want to set up your loan like this. And I always say it wrong. I say re-amortization, but it is recast. So that is where you make a large lump sum payment and they charge a small fee to re-amortize your loan to lower your payment, right?
That's right. So normally, say like you've had several customers recently like this where they only wanted to move one time and they qualified for both the new house and their old mortgage. But they planned on moving and then selling that house, and they had $150,000 or more in equity. Well, they didn't want a real high monthly payment. So this is only available on conventional loans, not your FHA or VA. So they close, they sell their house, they've got $150,000. Normally, you would just send the bank the $150,000. You'd shorten your loan term from 30 to 18 years, but that's not what they wanted to do. They wanted a lower monthly payment. So we set it up with our servicing company and say, hey, this borrower will be looking to recast. And then they just call them. They pay a flat fee. It's usually $450 to $500. That saves them on that amount of money probably $8,000 to $10,000 in closing costs if they had to refinance to use that money to get up the lower payment.
I love that. I use it with customers all the time. It's such a great program.
Yeah.
And I like to set my loans up that way just in case, I want to adjust something. I want to pay something down and adjust my monthly payments. I got a large amount that I want to be able to do that with.
That's right.
So let's talk about where I can get some cash out of my house. So I want to remodel. I want to add a pool. Maybe I want to do an addition. So I want to do something to my house that's going to increase the value. But how can I get that money out of my equity?
So 2 ways. We can look at a renovation loan where we would pay off your existing mortgage and take the contractor's cost for the renovation, add the two together for a new loan. It's got to appraise, of course. Things have to make sense. So we get your plans and specs, and we get the appraiser to appraise it, make sure it makes sense. Bathrooms, kitchens, pools, those things make sense and create value. The other option, if you have enough equity in your home, is a home equity line of credit. That way you can just focus on paying it off separately. And generally your home equity lines, your current mortgage plus the renovation or whatever you're pulling the money out for, can't exceed 80% of the value. They want you to have 20% value.
20% equity. And also a cash out refi. So if the rates have dropped and you're at a higher interest rate, couldn't I do a cash out refi?
So in a cash out refi, you wouldn't have to get a contractor involved. Same with a HELOC. If you do a renovation loan, you have to have a licensed contractor handle all the work. But if you've got equity and you can do it that way, that's a great way to do your renovation.
So let's talk a little bit about PMI. What does PMI stand for?
Private mortgage insurance.
So does it help me?
It does not. It only protects the lender if you're to default on a mortgage. Anytime you buy a house and you don't have 20% down and you do a conventional loan, you pay PMI insurance, and the PMI insurance is going to protect the bank if you were to default on it. We get paid what's owed on the house if we sell it for less than what you owe.
Now, what about FHA loans?
So FHA changed their rules. It used to be that once you had equity in the house, they'd pull it off. But back in 2013, they found that they were just doing way too many mortgages, and everybody was getting in a house for 3.5% down. So they made it where it stays on the loan for the life. So you can't get away with it without paying it unless you were to refinance it to a conventional once you have 20% equity. On a conventional loan, once you have the 20% equity, you can call the mortgage company and ask them to remove the PMI insurance. And if they agree with you, they'll remove it. But the PMI company gets it for 2 years, no matter what.
There's a minimum. So a lot of my clients are always asking me about investments. Let's talk about borrowing money for investments. How many ways can I borrow money to buy investment properties?
So you've got second homes and investment properties. If it's a true investor that's buying a property to rent them out, generally they're going to have to put 20 to 25% down. Rates are a little bit higher. It's the riskiest loan there is in the mortgages because you're always going to protect your primary. And then the next is your second home. And then investments is a higher risk. You're not living in the property.
What if I have a bunch of equity in my current home and I want to pull some of that cash out to use towards an investment, whether it's buying an investment in whole or using towards a down payment? Can I do that?
You could do the cash out refinance, but you might have a great rate on that property. Then you might want to do a home equity line of credit. Pull your down payment for the investment property out of your equity and then focus on getting that paid off as soon as possible so you're not using your primary residence as your investment. Get that paid off and then focus on your renter paying your mortgage for you.
I like it. So there are ways that I can actually use, or what I call leveraging.
That's right.
You know, I'm not a fan of debt unless it's making me money.
And some of these investment properties, the pricing right now, you can buy an investment property, borrow from yourself for a little while, and get that property on a steal. It's worth it.
So to me, that's leveraging, not debt. While I hate debt, I'm okay with leveraging. Right. So we're talking about this moving target of borrowing money. Let's talk about the craziest interest situation you have ever seen happen in a loan.
So I did save a veteran $900 a month on a refinance about 2 years ago. He got a really high rate. His credit scores were a little bad. When he first did it, a lot of debt. 2 years later, he came to me to refinance, and I didn't do his first loan. He told me the situation about it and why his rate was so high. Rates had actually gone, I think we were at like 5.5, and it was a large loan amount. So VA offers what's called a VA interest rate reduction loan. A lot of people see a VA IRRL, IRRL. It's an interest rate reduction loan and allows us to refinance without the need of the borrower to requalify for the debt. VA's already got the loan.
Oh.
We don't need an appraisal. They already have the loan. All we have to do is make sure that their credit scores qualify. So that was
awesome.
huge.
Yeah.
The other thing that helped, and that what we like to do, is we look at the insurance too. We look at everything. Where can our borrowers save the most money? And when we saw what he was paying for insurance, and we knew that the house was built in 2017, we're like, wait a minute, why are you paying $5,800 and you're not on the water? Yeah. And that's another thing, and I'll advise all my customers, watch your insurance rates. The rates just keep going up. Your agent doesn't have all that information. It gets changed all the time. You'll get the bill. So always pay attention to that. Shop around for insurance. You don't have to stay with the same insurance company, but if you want to, call them. Your agent doesn't even know that that's going on a lot of times. And when you call him, he's going to search and see if they can't get you something better.
So not only are interest rates a moving target, but so is our insurance payment. Our
FEMA just changed their flood map. You know, there's a lot going on out there.
So talking about this moving target of interest rates and home financing, you know, I've had people that tried to build a custom built home, and I always caution them in the beginning, you know, look, when you're building a custom built home and you're not doing a loan with Tracy because she'll lock you in at that rate. But a lot of times, some of these lenders are not, and they'll start out building a house at one interest rate. And then by the time the house is done on a custom home can be 11 months.
Right.
So 11 months down the road, when they're doing that permanent conversion of their loan for the next 30 years, that rate's locked in. And now it's 2% higher than it was when they started.
Can you imagine? What if you don't qualify?
Well, they didn't.
Now you just build a house.
And they had to bring cash to closing. Now, luckily, I had warned them about this, and they were prepared, and they were able to bring the additional cash to closing and still be able to go through with it. But if I wouldn't have prepared them for it, who would have had an extra $200,000 laying around?
Right, exactly. So that's our construction loans are phenomenal. We do a conventional construction. FHA is our new one. So you can do a construction loan with just 3.5% down.
Which is amazing.
As you stay at that limit for FHA 470s. And then VA, we can go up. VA doesn't have a limit anymore. So we do them up to $2 million with an exception, 1.5, one, lots of loans at that, 100% financing. But on the VA, what I love about The conventional loan, I'm going to lock you in. That's your rate. If the rates go crazy low at the end, then we'll look at renegotiating that rate to get you a better rate. On the VA, you don't lock. The builder locks because the builder pays the interest-only payment during the construction so that the veteran doesn't have a hardship with his current living expenses plus. And then when we modify it, it's a one-time close. You close up front. And then we modify the mortgage once the house is done, and we float your rate down to the cheapest rate available.
That's amazing for our veterans.
Yes.
So veterans can build a house at 0 down.
Right? All they pay is their closing cost, unless the builder pays them.
$1 million, 1.5, and they have no PMI on that loan?
No PMI.
And what type of interest rates are they going to be paying on that? Is that treated like a jumbo, or is it?
So that right now the VA, our construction rate for VA is 6.75.
So pretty close to current rates. So the construction VA rate isn't
It's
a lot
little bit higher, you know.
Not much.
Not
A
much.
quarter?
But then they can turn around, and what if a year from now we're at 5.25? They don't have to do anything. I'm going to give them 5.25. Because if I don't, they're just going to turn around and do a VA interest rate reduction loan and get 5.25.
Right.
So yeah, I love that for the veterans.
That's really a great program for all of our veterans.
That's right.
So Tracy, thank you for being here today and being on the show. I'm sure our listeners are going to absolutely love learning about these moving targets of borrowing money. Always a pleasure to have you on the show.
Always a pleasure to be there and give you all the information I can share.
You are such a resource, not only to me, but to this community and to all of our customers. So I really appreciate it.
Thank you. You as well.
So each week we like to do a home hack. So what is a home hack? A home hack is something that saves you time. It's a cool app or feature that just improves the homeowner experience, right? So today we've been talking about a lot of mortgage stuff. So I'm going to give you this really cool app, and it is Tracy Morgan-Frick's app. I love it. I use it with my customers all the time. When we're out looking at houses and I'm like, hey, what would the house payment be on this? I could punch it in real quick, get that estimate. I can go, well, what if we put another $10,000 down? How will that affect the payment? So it's a really cool app. All you have to do to get the app is text Tracy Morgan-Frick. Just text her and say, hey, I want the app. And it is 850-637-6060. And she'll shoot you over the app. You can have it right there on your phone at the touch of a finger. Real easy to calculate it. I use it all the time. So that's our home hack for you today. Thanks for tuning in. If you have any questions about this episode or an idea for an upcoming episode, please DM me on Facebook or Instagram. We look forward to hearing from you.